Good day, fellow investors. ADM stock is one that we discussed a few times over the last year, and now that new earnings came out, the stock is down 10% over the last week. Some of you have been saying it is a disaster. Others are more questioning about the change in fundamentals, uncertainty, and what's my position on the company now. The more a stock goes down, a stock that I cover, a stock that I own, the more I like it. And that's why in this video I want to give you a comprehensive overview of what investing is for me through the stock analysis, how does it fit a portfolio, and also I hope that it goes down another 30–40%. So if you look at my research platform, you have my free portfolios and a lot of covered stocks. But in this video we will discuss Daniels Midland to show you how does it look like when it comes to a deep analysis to know what you are buying and owning a business. So let's start with ADM stock analysis, and you can see here how I usually make 20–30 page reports when it comes to analyzing a business. And in that line, let's immediately start with the stock price overview, and the key thing to understand is the food cycle. As you can see, the stock has a compounding line over the long term, but there are these food commodity cycles that make the market very exuberant related to it, and then also very pessimistic. Pessimistic, exuberant, pessimistic. With such food businesses, you're likely going to eat tomorrow. We then know that there is a component of growth coming from long-term inflation related to food prices, compounding, investment, earnings, population growth, and that trend is clearly seen also in the stock price. And now the key is to buy and have correct exposure over that cycle. The market capitalization is now 22 billion. P ratio, forget about P ratios when it comes to cyclicals, and the dividend yield is 4.48%. Let's start with the business overview, and if you look at ADM, what is the business, what is the company? Well, they are a food processing business where they source the food, store it, and then process it and sell it forward. And they have more than 700 facilities across the world. The business is separated into 4 segments: agricultural services, processing, specialties, and you can also call carbohydrates a more stable segment. And you can check the investor presentation for more detail, but they own also 22% of the Asian version of ADM, Wilmar International, which is another covered stock on my research platform. And now when it comes to this business, profits depend on food prices. High food prices increase storage, processing, distributing, and all kind of margins. The opposite is also true with lower food prices in a downturn. And you can see exactly those profits relatively high, going down in a downturn, stabilizing, booming in 2022 and 2023 when food prices were booming, and now we are seeing a return into a food downturn cycle. If you look at the footprint, agricultural services and oilseeds, most in the Americas, something in Europe and Asia. Carbohydrates, a little more stable part of the business if we look at the footprint: North America, some Europe, and China. And you can see here the more stable lines of profits for example, starches and sweeteners. Then we have the bad child of ADM, which is nutrition. They did significant acquisitions over the last decade in order to increase that exposure, higher likely margins, and that didn't work for a while. There have been the accounting issues there that are hopefully now solved. We now have profits. They're still not yet as high as one might expected, but they are working on it, and maybe there will be improvements over time. So they are also going into animal nutrition with the 1.9 billion Neovia acquisition from 2019. And there have been these accounting issues as when it comes to these accounting things, there were shocks, stock market sell-offs and everything, but it was usually always related to just 10% of the company each time there was an accounting scandal in the news. So that is a risk, but then you just need to look at the long-term perspective of the numbers. Usually with food businesses, there will always be issues. That's unfortunately the nature of the business. Another issue, for example, is explosion at the Decatur plant, which is a nutrition plant that is supposed to come back online this year and therefore also increase profits. So they are always looking for acquisitions to implement into their large ecosystem, so small businesses, and then sharing across the globe with their footprint. When it comes to food, the sector has a positive structural tailwind, and that's always something that you look for, because when you invest in a sector with a positive long-term structural tailwind, then even if you make a mistake, the uplift of the strong trend going forward will help you, and even if you made a mistake, will help you not having a huge cost to that mistake. That's always a positive, and that's why I always prefer investing into businesses that I know the future is positive for them. You can see here global food consumption. It is slowly and steadily growing, and as the world is still growing and increasing also global income, then also food consumption might grow. And here you can see the beautiful food price index. Now we have negative situations, booming prices, negative situation, booming prices, negative, booming, and now we have already stabilized a little bit higher than it was the case. So down, up, higher highs and lower lows. That is the food cycle trend. And now with inflation, with likely more money printing going forward over the next decades for sure, that is how the governments will solve the debt issues and everything, it's likely then a real asset will benefit from inflation, and therefore that's another plus in the long term positive structural trend. And you can see over those cycles profits are down, then go up, then go down again, but over the long term the profits go up, and over 20 years ADM's profit went from $500 million to 3 billion on average. Profits were down for 2024 on all segments, cash flows also down, but still good at 3.3 billion cash flows from operations. The guidance has been lowered, that is something okay, $4 earnings per share. However, they are increasing the dividend, they still have a buyback program, unlikely that they will buy back shares, but when there is extra cash flow, that might happen. They are still investing significantly into development, organic growth, and nothing wrong with the business. If we look at the balance side of things, there is something that we have to discuss when it comes to this companies with long-term assets. There is 7 billion of goodwill. Okay, we will not touch that. But if you look at the property, plant and equipment here, you see that the accumulated depreciation is 18 billion now. 18 billion, and net property, plant and equipment is just 11 billion. If you look at plants, those are historical accounting costs of what it cost to build something like this. If you want to build something like this now, I'm sure it will cost twice or 3 times more than what ADM paid when they built it and is included in the balance sheet. So that is also one kind of margin of safety when it comes to looking at this. It's hard that someone will go and build something like this again next to it, because if you do that, then the return is lower. The result of being a business with a moat in a positive structural trend is the following: 50 consecutive years of dividend increases. And it is likely that they will continue increasing their dividends over time. When there is extra cash flows, they do repurchases. Usually that is combined with higher prices. That might be a negative, but okay, we have to calculate these things when it comes to investing in ADM. When they start doing big repurchases, you sell the stock to them, you buy then again in a downturn. That's perhaps the best way to do it. There are liabilities, but keep in mind they are a trading company. The equity, you are buying now things at book value. The cash flow highlights when it comes to these companies, when commodity prices go up, they need to increase the working capital to buy those commodities, store them, and then sell them later. When commodities go down, they can release the cash in the working capital, and lower prices increase cash flows for these companies. So even if you see those profits negative, it allows the company to survive 2, 3, 4 years of downturns because of the working capital decrease. There is still the share repurchase program. If they do it now, that would be great. And you can see here the change in inventories as prices went down, how it positively impacted cash flows, about 3 billion. So when it comes to prices, you can see here downturn, then they make 2 billion, they started with $500 million, then it goes down again. Then if we go to the 2010s, the lows are already 1.5 billion, not more, the 0.5 billion from historical, the highs go higher, and therefore when you look at a company like this, they made 4 billion, around 4 billion 2022-23. Now they will make lower, 1.7 billion, perhaps 1.5, 1.3 billion next year. The market is always oriented to the short term, and as the comment said at the beginning of the video, concerns fundamentals. It's just the cycle, but the market is wired in a way that when there is a downturn, that will last forever, and that is exactly the opportunity we have as value investors. And you can see the stock went close to 100 and now it's down to 50, but it was also close to 30 during the COVID crisis. What I always do, I look at the last conference calls, what they are saying, and to sum up, they already said that 2025 outlook will not be stellar. So that is something that we already knew, that allowed for perhaps buying at lower prices or waiting, but then the market always reacts to new confirmations of things that we already knew. So that is an analysis of what happened in the previous call, and we'll discuss in a moment also the new call. And then discussions of the accounting scandal, that is a risk, but it looks more like a risk to the stock price and market perception than real things. There was a big drop on the accounting panic here, with also declining food prices, so all in combination, but with the accounting issues, impairments, that is always something that will be there with food prices. This is the nature of the business. They have found the material weakness in those accountings and will likely incorporate those nutrition businesses better going forward. So there are always risks, droughts, outages, fires, accounting. That is something that I can guarantee you will happen again. However, they keep on investing. They have joint ventures, 5 billion, which is then a quarter of the market capitalization, and there are investing risks. You can always read through the annual report to see what is going on. A criminal probe for the CEO, so things like that will always come to surface, especially when the stock is down. Now, Q4 earnings update, you see everything a little bit lower compared to great 2023, but still positive. Carbohydrates are always stable there. Nutrition is improving from a negative, turning into a positive, stable operating profit, which is positive. Cash flows still there, 3 billion in cash flows before working capital changes. The guidance is uncertain, and here they tell you something, and then we have to, as investors, project this with the possible market reactions and possible buying opportunities going into the next 2 years. Because if the company says the future is uncertain because they don't know, and the market then If everything bad happens, it will sell again. If for any reason, downturn, food market, this or that, the company makes just 1 billion in net profit during 2025, the stock will go down another 30-40%. That's how the market works. No matter what the potential profits are in 2030, the market is extremely myopic, and that's our opportunity. So the outlook, earnings 4 to 475, maybe it will be 3. That's also possible. So that's something we have to take into account when it comes to investing. They are laying off, focusing on savings, which is normal in a downturn. They also talk about some asset divestitures in the most recent conference call. So they say they will see about buybacks, not planning. What business going? Ample global supplies, higher crash rates for Argentina, things like that. Tariffs could actually help ADM, but it's the retaliatory tariffs that would cost them more. So there is always a cost in economics. There is no free lunch. So we'll see how that evolves over times. All in all, standard analyst questions usually focused on the short term. Now, when it comes to valuation, they have been increasing dividends for 50 years and paying dividends for 93 years now, year in, year out, which is something very spectacular and peculiar. And let's go to an analysis. Now, this is my premium research platform template. You will see a difference between this one and the template on my free stock market investing course that you can download below. Same company, ADM, but the free one, the educational course, is more explaining what the market is pricing in, how it can evolve, and then you can put your own numbers. Here, this is my view, my indication of what I see are the absolute possible returns from investing in ADM. So let's discuss this. We have a dividend per share, and let's say that the downturn lasts another 5 years. So the growth rate for the first 5 years is just 2% for the dividend, and then likely in the next food upcycle, 6% growth. I expect, for comparative reason, a 10% discount rate, 10% return, terminal multiple 20 on the dividend, which is then again a 5% yield, and the intrinsic value is 36. This would be an average intrinsic value for ADM. Now, if we go to a best case scenario, let's say that the food cycle turns around next year, they increase the dividend for 6%, the market is back to wanting a 4% yield, then we are already below that present value. If we go to a negative, for 10 years, they just increased the dividend for 2%, the market expects a 7%, 6-7% dividend, the present value then is 27. This is the margin of safety scenario, and this is applied to a different portfolio on my research platform. So this is an overview. We don't know the probabilities, but we are already close to getting 7-8% from the company from that absolute perspective. However, there is also something else that we need to discuss when it comes to the company. The market cap is now at 21 billion, but the potential of earnings is 1 billion to, let's say, 5 billion in the next 10 years. What happens if they hit the 5 billion in earnings? Well, 4 billion, the P ratio will likely be, 15 on good numbers, everybody happy, that's 60 billion. So if just 1 year they hit that numbers, then we have here a 60 billion, 21 to 60 billion, that is a 3x, plus a potential 4.8 dividend that you gain on that numbers. And if it happens in 5 years, we are talking 20% returns. If it happens in 10 years, we are talking 10, 11, 12% returns. Still great numbers, and that's why I say it is already a buy. And then pushing the stock higher, possible repurchases on higher cash flows, but that is how you have to see the perspective. Now, when it comes to portfolio fits, if you look at my research platform, I have a diversified research platform portfolio and my personal portfolio and the model portfolio that has been a constant on the research platform since 2017, 18. Here, we just started investing in the company, just 2 purchases. The position is now less than 1% of the portfolio. Here, opportunistic, no position. The diversified portfolio there is, I think, now at the almost full position, but I still have another buy if we go below the 40s. So I'll keep watching it, and then I hope that the stock goes below 40, and then I'll add it more to the diversified portfolio. I'll increase the position in the model portfolio, and I'll consider it for my personal opportunistic portfolio. So when it comes to our quadrant, I have pushed, as the stock went lower, I have increased the long-term return on ADM. Likely will be around 10%, perhaps even higher over the next 10 years, which is then a very strong buy. And now you have to see how does it fit your portfolio over 10 years. Dividends growing, food cycle, positive long-term trend. I didn't eat since yesterday lunch, but I don't think that will impact food prices long term, and I hope the stock goes below 40, maybe 40, and then you have to see whether now it's, I don't know, 45, how does it fit your portfolio, the exposure 40 and 30, because it is cyclical, and I can't wait for all the comments to hit YouTube if it hits 30. I'll be smiling, people will be commenting, because now the outlook is for 1.5 billion in profits. But as I said, if it goes to 4 billion on the food cycle, 60 billion market cap plus yield, that is a 24% yearly return to 2030. So that's already something. It can happen later, it can happen sooner. The thing is that you get the dividend while you wait. You reinvest the dividend, hopefully at lower prices, maybe the company does some buybacks, and over the long term, you compound that. Check my research platform. There is more than 20 other companies with such deep analysis. This is what I do. I try to find businesses that I know with the highest possible certainty, anything can happen, will be there in the next 10, 15, 20 years, still growing, and then I wait for those businesses at the right prices, and those businesses with the dividends, with the growth, compound my portfolios. That's the strategy, and that's value investing. Follow for more.